Fox. Now, is it time to invest in commercial real estate? Let's find out. We've got an expert, analyst Anthony Paolone. He covers REITs, real estate investment trusts for JPMorgan. He joins us now. Anthony, U.S. office vacancies rising to their highest levels in 4 years. This in the second quarter. The jobs outlook, we know what the June numbers were. They were not great. What's the situation now in commercial real estate?
Yeah, well, fundamentally, things are still pretty weak, and we think they're going to be pretty weak for the balance of this year and probably for all of 2010. So we think that the job losses are starting to really impact occupancy levels. You're seeing it take a pretty substantial toll on rents, and the fundamental environment's going to be weak.
All right, if the fundamental environment is going to be weak, does this mean stand aside to all commercial real estate investment trusts right now and see kind of where the dust settles, or are there some ways in which we can go prospecting?
Yeah, in terms of ways to potentially play it, you still have the commercial REITs, the REITs out there, which the stocks have reflected a bit more than where the private market is at this moment. So the stocks offer, we think, maybe a little bit more value than potentially going into the private market at this point in time.
Why is that? I'm just curious. Is that because they've just had better access to capital than the private market?
And part of it is better access to capital. The publicly traded real estate companies, the REITs, are a lot less levered than the private market companies are, at about 60 to 65%. So that's a big part of it. But also as stocks, the market has priced in some of what is to come in advance of it actually getting here. So you're starting to see things occur in the private market, and we think the stocks have reacted already in large part to those things.
All right, so I guess also because there's such huge liquidity in the public market that you want to get out, it's a lot easier than getting out than the private market.
You do. You have a daily mark-to-market and the ability to price in what you see in the future immediately.
All right, let me talk to you about pricing the future when it comes to, I want to talk about Brandywine Realty Trust right now. They've renegotiated some deals right now. I mean, what is the situation with them and their banks?
Yeah, Brandywine is a company that we upgraded at the beginning of the year. And the idea behind it was they had some pretty challenging balance sheet items to get through, and the company is getting through those items. They pulled a very big mortgage on a property that they're redeveloping in Philadelphia for the IRS. And that takes about $250 to $300 million worth of balance sheet pressure that would have been on their line of credit off of the company. It's a very good transaction. And that, combined with some other items, really lifts the liquidity concerns off of this name. And this is something that we were hoping was going to happen through 2009. It is happening, and we think it's going to bode well for the stock.
Now, do they have any debt maturing, any secured debt that matures in 2009 that we need to pay attention to?
Not a whole lot. It's very small. What's left in the next 6 to 12 months is quite manageable. And again, because of the large deal they did at the IRS Center, it takes a lot of pressure off their line of credit. So the line of credit is pretty open for them to use.
Now, what about the yield right now? About 5.3%. Let's call it 5%. Is that dividend covered?
The 5% is covered, but what is somewhat unique to Brandywine is investors in this will likely end up getting more than the 5%, because what they're doing is they're paying out a fairly small dividend now, and they will likely have a catch-up payment, depending on how much they earn throughout the course of this year, that investors will get at the end of the year. So the 5% is likely the low end of the band as to what investors are going to get. You'll probably end up doing better than that.
Now, one of the things you wrote in a recent note was how they extinguished some debt and that created some income. How much are we going to see from that process?
Yeah, well, a lot of that is partly accounting, but partly real. What Brandywine and some other REITs have done, which we think is a good thing, is they've gone out into the open market and they've repurchased their own debt, which is trading below par, and notably below par for a lot of companies. And what accounting requires you to do is book the difference between par and what they repurchased the debt at through as income. So you have to somewhat ignore it from an earnings point of view, but from a practical point of view, they're repaying debt at below what they owe effectively, and that's a good thing.
And so that should help the earnings?
It should. It should over time.
And when you look at the cost of the stock right now, how do you actually arrive at a target price, and where do you get the multiple?
Yeah, what we look at is we look at what we think the company could earn over the next couple of years, and then we take a longer-term perspective and think of what their secular growth rate might look like. And for a company like Brandywine, we think that's probably something in the 3% range long-term. But in the meantime, you've got a stock that's trading at less than 8 times cash flow with a dividend yield that will, as we talked about, likely be above 5%, and is getting through balance sheet issues that were weighing on the stock just a few months back. So to us, you add those things up, it looks like a pretty good story in a stock that we like.
All right, and the stock about $7.40 on the close today. You still got your $9 target there.
We do.
Now, if you've got $9 on the target, is there any kind of assumption as to dispositions? In other words, are they going to be selling anything, and what happens to the income there? How much do you think they're going to be able to realize?
Yeah, we do have them selling about $150 million worth of assets in 2009 and probably another $100 million in assets in 2010. We just assume that those cash proceeds will be used to pay down debt. We don't assume that they're going to use that money to go buy anything at this point, because right now, again, the focus is on fixing the balance sheet.
All right, fixing the balance sheet. What about those core occupancy levels? Are we going to at least stabilize at these rates?
Well, they're going to continue to go down. Again, you can't avoid the job picture, which is that demand for office space is weak. But that's something that we assume in our numbers. We assume that their occupancy declines by about 100 basis points a quarter for the next several quarters. And we think that should incorporate most of it.
Okay, all right. We're going to continue the conversation with Anthony Paolone. We're going to talk about the future for many REITs. It comes down to if you don't have a job, it's hard to make a rent payment. It's hard to fill up that office space. How that one issue, employment, plays out in so many ways. Rent prices, geographic locations. We're going to talk about Entertainment Properties Trust with Anthony Paolone, an expert in the world of commercial real estate. This is Taking Stock on Bloomberg. A programming note, Taking Stock every day, 3 p.m. Eastern on Bloomberg, 1130 a.m., XM Channel 129, Sirius Channel 130, and on Bloomberg.com. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest is Anthony Paolone. He is an expert in all things related to commercial real estate investment trusts, coming to us from JPMorgan. Anthony, let's turn our attention now to the entertainment side of the real estate business, because I know that you've been following what's going on at Entertainment Properties Trust. They've got some challenges, right? I mean, they're about 20% of the portfolio, 3 big developments not coming in as strong as everyone expected. Am I right?
That's right. They've had a tough time the last few quarters. There's been a few projects that they've done, namely a water park, a potential casino deal, and a mixed-use entertainment project up in Canada, in Toronto. And all 3 of these deals really haven't penciled out the way they expected them to, and it's weighed on the stock. All
right, so if it's weighed on the stock, why do you still have an overweight rating?
Yeah, because a couple things. One, we think that a lot of it got priced into the name already. And what we've done with our numbers is we think we've taken a pretty conservative tack. So, for instance, as it relates to the casino deal, we valued it at 0. As it relates to the project in Toronto, we've brought that in with no income this year at all and very little income next year.
That's the Toronto Life Square development, right?
Correct.
Okay.
And then on the third deal, in the Schlitterbahn Water Park in Kansas, that deal has actually been largely resolved. So we kind of know what the outcome of that is. And so we think our numbers have largely factored in what's happening at the company. And when we look at it and step back and say, okay, on these more conservative assumptions, where's this thing trading? It's trading between 6 and 7 times cash flow, with a 12 to 13% dividend yield. And we think this is a company whose underlying assets in the large majority of the portfolio, being in movie theaters, are performing pretty well.
Now, when you do the comparisons, right, 6.5 times cash flow compared to what for the industry group? We're talking about 9, 10 times?
No, the overall industry is closer to 13. So it's a pretty substantial discount relative to the broader REIT industry. Relative to some of their more direct peers, it's still a discount, a little bit less, but most of their direct peers are trading somewhere in the 11 times cash flow.
And how about that 13% dividend? Is that covered?
It is, and we were pretty critical of that when we lowered our numbers and revisited our rating to make sure that even on our estimates, which we think, again, are incorporating quite a bit of bad news, they can cover the current dividend. And that dividend was reduced already. So we think investors will be in pretty good shape to get a 12 to 13% yield from this name, and we think at $20 or thereabouts, where the stock's been
trading.
trading.
$19.66 on the close today. What do you got, a $30 target on this?
I believe
25. It used to be 30.
It used to be 30. We brought it in for bringing in our numbers to account for them earning a little less money over the next several years. We think it can get to 25 bucks.
What about raising new money? Are we going to get any kind of share dilution? I mean, you always got to wonder what goes on in the REIT business if they're trying to raise more money in the marketplace.
It's possible. I don't know that you get it in the next couple of quarters, but we think you will get some of that over the next couple of years. And in part, we think that's a good thing for EPR because there are going to be opportunities for them to buy assets, potentially movie theaters and some other properties that they might see in the market. And so their use or their ability to go out and raise capital, we think will have a use for that capital, which is buying things, which we think is a good thing.
And they just got, what, like a $200 million line of credit?
Yeah, it was a little bit more than that. I think it was even a little bit more than what the company was anticipating. It was done a few months prior to what we were expecting, so we think that's good. It puts to bed a bit of an issue as it relates to the balance sheet.
And if they're getting the line of credit, that must be somebody at least voting, having a vote of confidence in what's going on at Entertainment Properties Trust.
That's right. I think it was 8 banks, actually.
All right. Eight votes of confidence. Not bad in today's market. Price target $25 for Entertainment Properties Trust. Thank you very much, Anthony Paolone, coming in and sharing your thoughts about commercial real estate from JPMorgan.